been lied to for far too long about dividends. Today, I'll be exposing the truths behind dividend investing and tell you how to grow a monster portfolio to exponentially increase your net worth. Welcome back, everybody. I hope you're having a wonderful day. I'm upset. For years now, I've been going on Instagram and I've been seeing all these people talk about passive income and how I need to invest in this latest dividend stock to get passive income every month. It is the most nonsensical thing I have seen over and over and over again. I've personally had friends put their money into these value trap stocks that yield them barely anything, and they're convinced, oh, well, because I get a dividend every month, it must be good. No, it's a lie. It's baloney. Please stop believing these people. It's frustrating. I've seen far too many people just lured into this trap of, oh, you're going to get paid for doing nothing. Ladies and gentlemen, if it's too good to be true, it probably is. Passive income is a lie. There are very few things in life where income is passive, and generally, to truly have passive income that you live off of, you need to have a heck of a lot of money. Go get some T-bills, go get some bonds. You want passive income, buy those and live off of them. There is no sense in putting your money in these stupid stocks that give you 14%. Why would you buy these terrible stocks if you could instead buy into high quality growth companies that compound greatly over time? And if you need some money, if you happen to need some money, just sell some shares, man. Sell a couple of shares. You don't need a dividend. Get over yourself. I'm also going to go over how dividends are a forced tax event, and nobody really talks about that, how every time you receive the dividend, you have to pay a mandatory tax on it because we live in the United States. Every time a company gives you a dividend, you're actually taking money out of the company to put in your pocket, and that's really important because that money could have gone back into the business to actually help the business grow and expand and further compound your net worth. Why do you want the money? What are you going to do? You're useless. I'm useless. We're all useless, right? I want the smart people in the high ivory tower offices in Silicon Valley to take care of the money and instead reinvest those dollars back into the business and help grow so that my portfolio can grow at 30% a year. That's what I want. The other thing is I'm going to talk about high dividend stocks and how they're often value traps for investors. So first of all, when you look at companies with high yields, they all share very similar characteristics. Number one, they're generally mature and slow growth companies. So you look at AT&T, Verizon, right? These are all extremely mature companies. Their market share is saturated. They're not really growing year over year. All they're doing is sort of staying stagnant, maybe declining over time, and they're paying off a dividend to their investors. They're relatively stable stocks. They're not high volatility, which is kind of nice. But the price is you're not earning a lot of money off of these stocks. The second is the stable cash flow generating businesses. So you can think of REITs, so real estate investment trusts. Those are businesses where they have a constant, steady flow of cash coming in, and they really can't expand the business anymore, so they just give away excess cash flows in the form of dividends. Cyclicals and commodity-based sectors like energy, mining, and oil also generally have high yields because, again, they don't grow very quickly. They're usually very large players who have been in the business for a very long time, and the business generally only grows at either the rate of inflation or however quickly their sector is expanding. They're not taking market share generally, they're based in one geographic location, so it only makes sense to pay dividends versus reinvest back into the business for expansion. The fourth and the most dangerous of these companies are the declining or troubled businesses. A lot of times, businesses, when they get in trouble, in order to appease shareholders, what they'll do is they'll say, oh no, my business is in trouble? I'm going to give away a 14% dividend to make up for that. That'll sort of make the investor happier, even though we're on the download destroying their net worth. Stay away from these companies. They're a nightmare. I'm sure you guys have seen, I had a friend talk to me about when he was 17 or 18, his parents gave him money to invest in the stock market, and he found some Argentinian company that was going under, and they were paying a 15% dividend, and he was like, score! 15% dividend, 15% rate of return, and of course the company goes bankrupt 5 years later. Yeah, be careful. Please stay away from these businesses. But overall, when you look at the big picture of what these companies are with high yields, they're not the companies that are going to make your net worth explode. They're going to slowly grow your net worth. But if I'm 20 years old, if I'm 30 years old, am I really interested in a 3% yield, a 4% yield? No! Why do I want 4%? Now, I went online and I looked at the compound annual growth rate over the last 10 years for some of these notable big companies that I see a lot of people invest in. All of the returns, including the dividends, are included in this compound annual growth rate that I've calculated. When you look at AT&T, 6.57% a year. Procter & Gamble, 10.18%. That's pretty good. That's not bad. But it's not higher than average. It's a little bit lower than average, right? I think the S&P's returned about 12 to 13% in the same time frame. O, which is a real estate investment trust, 6.25%. XOM, also known as Chevron, returns 6.74%. Ladies and gentlemen, there is a saying I have on this channel, and it's, if it's not over 15%, it is not worth my time. And guys, I don't know if you can do math. I'm not very good enough with numbers myself, but I know that all of these numbers are not above 15%. Now, there is a place for income stocks, high-yielding stocks in a portfolio. I think it's for people who are generally older, maybe in their 60s or 70s. People who maybe retire early, something along those lines. But for somebody who's trying to explode their net worth, somebody who's trying to turn their portfolio into a compounding machine, these aren't the stocks for you. These aren't going to grow you into a super wealthy person within 10 or 20 years. Maybe 40 or 50, but you could be dead by then. In general, when we look at the overview of these companies with high yields, they're already pretty mature companies. They're not growing at very fast rates, and that's why they pay the dividend to make up for the lack of growth. When you look at AT&T and Verizon over the last 5 years, this sort of kind of paints my picture. It is a high yield stock for a reason. AT&T's gone down by 8%, Verizon's gone down by 26.53%, all while they've been paying 4% and 6% respectively on their dividends. It's a high yield stock for a reason. They're not growing their top line revenue that quickly, if at all. You have to be really careful when you look at these companies because a lot of people will be drawn to Verizon and AT&T for their high yields. However, most of the people who start getting into investing, they're pretty young. They're in their teens or their 20s or 30s, and they think, oh, dividend, that's guaranteed money. That's a guaranteed return. However, behind the scenes, you're barely even beating inflation. And so if you want to create a nest egg, it's just not the best option. This is my biggest gripe with dividends. As somebody who's a growth investor, I want the money that's within a company to stay in that company. Because instead of coming to me, which what am I going to do? I'm just going to reinvest it into another stock or reinvest it into the same stock, right? Rather than the money coming to me and me doing that, I would just rather the company keep the money, reinvest it into its business, expand that business so that the shares that I own compound at a higher rate. For example, CrowdStrike. CrowdStrike is a really fast-growing company. They don't pay a dividend at all, and I like that. I prefer it that way. I want George Kurtz to take every freaking dollar that company has and put it back into making their cybersecurity services the best in the world. I want them to maintain their market dominance. I want them to improve the quality of their products. I want them to expand geographically into regions that they might not have exposed their business to yet. And most importantly, technological dominance. I am a tech investor. I am so heavily concentrated in tech, it's not even funny. As a technology company, you need to take the money that you have and invest it, not in my dividend, but rather in maintaining the technological moat that the company has to maintain yourself as a winner and as number one in your industry. Overall, and I underlined it for you because I'm a good PowerPoint maker, dividends take away from the mission of the company, which is to make me money. Make me more money. And don't tax me on it, right? Now there's this book, and it's called The Snowball, and it goes over the way Warren Buffett made his fortune. So The Snowball describes Warren Buffett's investment philosophy and exactly the journey that he took to become the multi-billionaire that he is. And basically what he did was he bought into these companies who grew a lot. I'll give him that. He's a dividend growth investor is what I would say. But these companies grew a lot. And then every time that they paid him dividends, he would take those dividends and either reinvest them into the company or use that cash to buy into a new position. So that's what Warren Buffett does. He takes the cash that's returned from the dividends in his portfolio and invest them into good opportunities. I don't think there's anything wrong with that. But what if, and hear me out here, guys, instead of just requiring a dividend, which, by the way, when you receive a dividend, the share price of that stock drops by the same amount as the dividend. So if you have a $5 stock and they pay a $1 dividend, the next day in the stock market, you're going to see that it's now a $4 stock. So instead of doing that, Why wouldn't I just sell shares of the company that I don't like anymore and reinvest my capital into the company that I do like, into my better idea? I know, it's hard to wrap your mind around. But either way, I'm getting taxed. The only difference is with a dividend, the company is forcibly giving me money. And I know that sounds weird, forcibly giving me money. I don't care. I don't care about the money. I'm not living off of this yet, right? I want my portfolio to compound and grow at the highest rate possible for the longest amount of time possible so that I can retire on the beach with my hot wife and sip martinis, okay? I don't need a dividend. I respect Warren Buffett entirely. I look up to him a lot. I just don't think I need a dividend to accomplish what he did. That's all. I don't think enough people talk about this point. Uncle Sam, whenever you get a dividend, wants his slice of it. When you sell shares and you get capital gains, you're going to have to pay taxes. When you get dividends, you're going to have to pay taxes. So just an overview of what our tax system in the United States makes us do. When you receive a dividend, you have to be taxed in the same year that you receive them, regardless of what you do with that cash. So you get a dividend, and no matter what, you have to pay a percentage back to the government. Now, there's two types of dividends. There's qualified dividends, and there's non-qualified dividends. For qualified dividends, there's actually a reduced tax rate. A qualified dividend is generally from a large, long-standing, established company in the United States who takes some of their gross revenue and reallocates toward a dividend. So think about the S&P 500. Basically, nearly all of those companies are giving away qualified dividends. Non-qualified dividends come from other companies, and instead of being taxed at the reduced tax rate, they're actually taxed at your income tax bracket. If you make a little bit of money and you're only in the 12% tax bracket, that's great for you. But I assume that as we get older and we start making more money, you're going to end up being in some of those higher tax brackets. So if you're in anything above a 20% tax bracket, you're kind of toast. Capital gains are probably some of the most advantaged tax rates in America. Capital gains are only taxed when you sell the asset, and there are two types of capital gains. You have the short-term capital gains and the long-term capital gains. If you hold your investment for longer than 12 months, that's considered a long-term capital gain. If you buy a company today and you sell it in 5 months, that's a short-term capital gain because you didn't hold it for longer than 12 months. The long-term capital gains are there to incentivize people to hold their shares for longer so that they're taxed at a lower rate. This is a table of the actual tax brackets. Long-term capital gains are somewhere between 0 and 20% based on your yearly income. Short-term capital gains are taxed at your ordinary income tax rate. That's your tax bracket that you're in based on your earned income. Qualifying dividends are the same as long-term capital gains. Ordinary dividends are between 10 and 37%. So you can see that qualified dividends are better, but nonetheless, they are still taxed at least in the same way that capital gains are taxed. So that's why I'm saying, why would I not just sell the shares by myself if I wanted money? I don't need a dividend. I just go in my brokerage account and I press sell, and most of these brokerages have free commissions. So why not just do that? So I think I've done a pretty good job of spelling out why I don't like dividends and why I don't like dividend and income stocks. So the question is, Alex, what do we do instead? If I don't have dividends, if I don't have my passive income, how am I going to function? Dude, let me tell you, forget about the dividends, man. They're not important. They're sort of just like a cherry on top. Back in a previous video, I talked about good asset allocation within a company. And what that means is the money that a company has left over should be somehow returned to the shareholders. And there's a few different ways to do that. You do share buybacks, which is sort of like a dividend if you think about it. Companies will go into the stock market, buy back their shares, and that will actually inflate the price of each share. So if you buy back 2% of the shares, theoretically the share price will go up 2% because now each share is worth more. The second is dividends, and you can have stock dividends or cash dividends. And for the reasons I've already outlined, I don't really want cash to flow out of the business. And I think one of the best things to do with money that a business has left over is reinvest it into the company. Don't worry about pleasing the shareholders with some cash. I want the business to do well and compound at really high rates, maintain their technological advantage, maintain their moats, expand their reaches far and beyond the United States, and make more money. That's the best thing you can do with free cash flow. So, on top of forgetting about dividends and just having it there as a cherry on top, get a job, work, earn money, put the money into your bank account and then your brokerage, and then when you see an opportunity to buy a really high quality company, that's when you buy. Okay, let's not get tangled up into this weird fad of, oh, I just want to sit down and do nothing all day and I just want to get money because I invested into some high dividend stock. It's stupid. Go out there, find purpose in life, take responsibility, and create a nest egg of really amazing quality compounding machines rather than sitting down, finding some random Argentinian company that's returning 15% and slowly but surely going toward bankruptcy. Once you create an amazing growth portfolio, so you and your little sweetheart can sit down at the age of 50, 60, 70 on a beach in some chairs and a cute little hat and a little sundress, and you can toast to the fact that you made good financial decisions and you invested in companies based on the quality of their business model, the quality of their fundamentals and financials, rather than how high of a dividend yield they have. I plead with you all, please do not get stuck in the trap of finding companies that are value traps and they look like they have a low PE and they look like they have a high dividend yield, and you think, oh, that's guaranteed cash, I'm going to buy in, because it's just going to waste your time. You're going to get 3 to 6% a year. You're going to maybe beat inflation if you're lucky. And in 30 to 40 years, you'll have barely anything to show for it. I want everyone to succeed. This is not financial advice. However, this is my investment philosophy that I follow, and it's done pretty well for me. And if you want to see how well my portfolio did, check out this video. Thank you all so much for watching. I really appreciate it. I hope you have a great and blessed day, and I'll see you in the next one.